Um, Thank you very much for joining us on this Q&A session that we're doing for 20 minutes today. I'm conscious that some of you may be listening to this on playback as well. So again, we're going to make this, I suppose, a short kind of interactive session for those who are on the call live, going through really about managing your savings, investments and pensions during times of crisis, I suppose, but volatility. And it'd be remiss of me not to mention what's happening, obviously, in the Ukraine. It's an awful situation, and hopefully it will be resolved sooner rather than later. But really, this afternoon session is about trying to help people kind of, I suppose, navigate through that, making sure that you are best positioned in relation to your own personal, I suppose, finances. I'll just start quickly by saying we are launching a poll there, which hopefully you can see on the screen. I see some of you have already started populating it. Just what is the biggest threat to our savings? So obviously, please feel free to answer the poll questions during the course of the session today. I'm joined by one of my colleagues, Cleo O'Donoghue, who's our Director of Business Development, and also Keenan Cunningham, who's our Marketing and Business Development Manager, who assisted me on the Q&A today. So I'm going to go into basically just a few very quick slides and an intro. For those of you that are not familiar with us, we're a progressive financial services company, primarily based in Cork. There's currently 8 qualified financial professionals, and we have over 50 years of financial services experience between us, giving advice in various different areas, and we're providing them complimentary to anyone that is on this call who would like to set up a Zoom with us for 30 minutes. And I would encourage you to take advantage of that, particularly in relation to some of the areas that we're going to cover today. The biggest, I suppose, piece of advice that I'd like to leave you with, and the biggest takeaway from today, is just to check in with yourself in relation to different investments or pensions or savings that you have, and just make sure that they are appropriately invested. And what I mean by that is that the scale that I've just put up on the screen here goes through different aspects of risk. Now, sorry, I should have said as well, please do ask questions on the Q&A tab. We are going to get through all the questions. Some people have already asked questions prior to today's event, but please do ask questions on the Q&A. We'd like to kind of be able to, I suppose, make it as meaningful as we can. But just going back to what I was saying there about saving and your pension investments, this risk table is really important. It's the thing that I always speak to clients about whenever I'm speaking to clients, whether it's about their pensions, whether it's about their savings for their children's education, or saving for a mortgage or a property, is just to ensure that your money is invested appropriately. The first risk level 1 is really your cash deposits, which I'll touch upon in a moment. The other end of the scale is high risk investments. So these are investments such as the likes of Far East Asian equities, for example, or investing in cryptocurrencies. And what I say to my clients is that you have to apportion your money in the right area. So for example, anyone who's investing towards their pension scheme, who has more than 10 years before they want to draw the money down, they should be taking a higher risk level rather than someone who is investing, say, for a property who's looking to buy in the next 12 months. And that's a general, rule of thumb that I always want to kind of make sure that people are fully understanding of. There's been, I suppose, some concerns about inflation. And again, one of the questions I'll answer shortly will address that. But inflation is expected to rise. We've been through a period of very low inflation for several years now. There's a lot of questions around what impact it'll have on savings, how it's going to affect, I suppose, people's standard of living, and what it means in relation to interest rates and so on, which I will cover off shortly. But again, it's something that we can go through with you specifically on a one-to-one. And again, just to remind you, please do ask questions on the Q&A chat, guys. We really do want to make sure that we are addressing any queries that people may have. So just to, I suppose, get back to savings at the moment, as we all know, in the post office, banks, credit unions, are really only short-term vehicles. And I say this to clients that typically anyone who's saving for less than 3 years should primarily stick to those institutions. but anyone who's saving for any period longer than that. So if you're saving for a new car in 5 years' time, or if you're saving for your kids' education in 18 years, you really need to look beyond that. And that's the key message, I suppose, for today. Why are deposits bad over a long period? I've just put up a slide here showing the effect of inflation, even at very moderate levels, over a 15-year period, and the effect it has on our money. So you see here the example of Michael, who has 100,000 in saving. If you take an average inflation rate of, say, 4% a year over 15 years, it basically halves the value of their savings. So it reduces the 100,000 in real terms in 15 years down to about 54,000 euros. Now, again, the medium to long term, I suppose, prospect for inflation, in my opinion, is going to be around that level. It won't be at the higher levels, certainly not in respect of what we're currently experiencing due to a few things that are happening at the moment. I'm just going to share with you 3 slides, and then I'm going to go into the Q&A. And these are taken from one of the partners that we work with, which is Zurich, who kindly provided these slides to us. And it just talks about the principles of long-term investing. And this is what I was saying earlier about the fact that really over history has shown us cash is not the long-term answer to our investments. So I know some of you may be concerned about, where your investments lie, but really the fact is that time is the healer. And the one thing I want to kind of stress upon all of you today is that whilst, many of us are quite emotional about what's going on in Russia and the Ukraine, it's not always a good idea to make knee-jerk reactions to. Time generally tends to be the healer. And again, it may vary depending on anyone's specific situation, but I would say that certainly, typically history has shown that the longer term, it makes sense to keep staying invested in the market. We are seeing a lot of volatility at the moment. It may surprise you to know, but stock markets are currently up over the last 2 weeks, which, despite the fact that they have fallen since the start of this year, the irony is that a lot of the falls took place before the Ukrainian crisis. It was mainly due to the advent of the likelihood of a rise in interest rates. So the key thing is that anyone who has invested in their pension, anyone who's invested in any form of kind of alternative to the banks, the fact of the matter is that even, take an example of Black Monday back in 1987, the year still ended positive for most stock markets. And that's one message, I suppose, just to hang on to. The last thing I want to say just before we move into the Q&A section is that the most important aspects of investing are to stay disciplined, to note that keeping your money in cash is not really a long-term answer, and that it's important to diversify. The most, I suppose, important thing that we say to our clients is ensure that you have balance in your overall financial positioning and that you're not overly exposed into any one particular asset. Okay, so that's really the main messages that we wanted to give today. Now, I'd like to, at this point, introduce my colleague, Cliona O'Donoghue, who has been compiling some of the questions that we've received over the course of the week, and obviously we'll take further questions that are asked during this part of this segment. So, Cliona, if you would like to maybe start.
Perfect. The first question, Nick, is should I look to de-risk my pension at this time?
So based on what I've been saying over the last 5 minutes or so, typically it wouldn't be sensible to de-risk your pension in lieu of what's been happening in markets over the last couple of months. Really, the most important thing is to look at where your pension is invested and that it's appropriate to the time scale that you have. As I said earlier, the longer you invest for, the more risk you should accept. So if you're in your 30s or 40s and you're not looking to draw your pension benefit until you're 60 or 65 years of age, you should stay invested in high-risk funds because you've got time to go through these peaks and troughs that we'll inevitably see over the next few years.
Okay, another question here is, how do I know what my pension fund is invested in and how can I find out?
We provide a very useful service for people. It's a really hassle-free way of getting information. Typically what we ask them to do, and the only thing I ever ask of my clients, is to complete an authorization. It takes 20 seconds. We send it via email. It doesn't cost anything and there's no obligation to take the advice. But we reach out to the various life company, the insurance provider, the pension trustee, and get details on their investments, their pension, and we report it back to them with no obligation on their part. But the key thing really is that when I speak to clients and they say, oh, I think I'm invested in a high risk fund, or I think I'm in some managed fund, it's not really specific enough. And I think the one thing that I would always ask people to do is just to sharpen up a little bit about where specifically, in which life company and in which fund their money is, because only by doing that can you get a proper sense of, are you correctly exposed in the right area, in the right risk category?
Okay, there's another question here. It's, how do I know if my portfolio is exposed to Russia or not?
So Russia is what's classed as a developing country. So a lot of the insurance companies' exposure to Russia would be very, very small. Typically, most insurance companies only invest in the developed world. So that would be primarily the US and most parts of Europe, ex-Russia, of course. Again, what I was just answering on the previous question is that the only way you can really know is by getting a professional to look at, you know, the funds and the makeup of those funds, or indeed to ask your own investment manager or broker. And information is key, of course. But that doesn't mean that there won't perhaps be some knock-on effect. For example, commodities in general have risen over the course of the last week. And there may be some implications for other countries in terms of what's going on. But again, the easiest way to do that is to get a professional to look at it on your behalf, and typically without paying a fee for doing so.
Okay, I think that answers the question, because there was a question came in around Russian default on debt and what impact will this have on the markets. There's another question that has come in about 5 years to go to pension drawdown and now on level 4, what should I do?
I would do nothing in that instance. Typically, the way that the cycle operates on the scale of 1 to 7 is that when you're in your kind of 20s and 30s, you should ideally be up around this level 6, and then you graduate down to 5, perhaps in your 50s, late 50s, early 60s, you go down to a 4. Now, the old school of thinking was that you completely de-risk the year or two before you draw down your pension benefit. But because of the change in the way that people draw their pensions now, 75% of your pension fund is going to remain invested once you draw that down. So the irony is that some people who have just retired their pension schemes at a nice old age of 60 or 65, they actually take more risks than those of which who have drawn down their benefits prior to that. So in answer to the question, I think a risk level 4 is appropriate for someone who has 5 years left, and maybe taking 25% of their fund in the last 3 years into a slightly lower risk level for the cash element that they're going to draw from the pension scheme. That's how I would typically position someone.
Okay. Another question here is, some growth stock investment trusts such as Scottish Mortgage or Monk's Investment Trust have nearly halved in value. Do you think this is a buying opportunity, or do you think the rotation from growth to value at the start of the year is here to stay?
That's a really good question, and it's quite specific. I suppose that the high level answer to that is, just because something has halved in value or fallen significantly doesn't mean that it can't continue to fall. I'm not really particularly interested in people becoming speculators. We've had a lot of people on to us recently about cryptocurrencies and about the fact that they've fallen so significantly. Not particularly an area that I like at the moment. I think there's a lot of headwinds in that particular space. But in answer to your particular question, it may form a very, very small part of someone's overall portfolio, but wouldn't be an area particularly that I think would make sense. It's not really broad enough from the point of view that the key message again today is about diversification, letting the experts manage your money and letting them make the important decisions that they're typically paid for.
Okay, next question is, any particular advice for a recent graduate, debt-free, who is looking to set up their first pension?
Well, if they're joining a company that has a pension scheme in place, that would be the vehicle to use. It's the only vehicle really, and obviously it's beneficial that an employer pays towards that. If it's a case that there's no pension scheme provided by their employer, again, we offer pension schemes in all different varieties. The key thing is to make sure that they achieve the pension at the lowest cost possible, so deal with a low-cost broker and get independent advice. Part of the problem tends to be that, for example, if the banks are not the tied agents, they're not independent. So AIB, for example, deal only with Irish Life, Bank of Ireland only with Bank of Ireland, and they're not particularly competitive. So the key thing really is to shop around, get appropriate advice, and more importantly, know what you should be contributing and what it's likely to achieve for you in the right risk level.
Okay. There's a lot of questions coming through, so I'll just keep on asking them. Performance has been good over the last few years. Can the gains made in this time be removed from the lump and invested in safer areas?
Well, they can be in that, there is an opportunity for people to look at where their portfolios are. So, for example, somebody who's invested 100,000, let's say, into their pension fund over the last number of years, and the value has gone up in, to say, 150,000. But there's no sense. And again, if you're listening to what I've been saying since the start of this webinar, trying to guess what's going to happen in the market is not really what I would suggest someone tries to do. We've seen this before when COVID happened. The anxiety that caused a lot of people to go into cash was unfounded. Markets oversold, which is what we believe has happened, and then they recovered very quickly. And if more so than they had started prior to that. Fundamentally, as bad as the situation is in the Ukraine, nothing fundamentally has happened insofar as these companies, the main companies that are invested in, are going to continue to perform and grow in value. There may be a slight shift. A lot of people were looking at, say, buying oil early in the week, very speculative, and the price of oil fell significantly on Wednesday. It's a high-risk asset. I would warn people against trying to be too speculative. So no, I'm not really that keen for people to try and take profits if it doesn't, suit their own personal situation.
In relation to the monthly Zurich saving plan, is it better to decrease the amount saved or freeze, or is it okay to increase the amount?
The Zurich savings plan, which is one of the preferred plans that we advise our clients into, it's a really flexible arrangement which allows complete flexibility of payment, and more importantly allows people to exit. They can withdraw fully or partially without any penalty. But the answer to the question really is dictated by what other, I suppose, outgoings does that individual have. It sounds to me that maybe they're looking to reduce the amount that they pay, but it would just be predicated by their financial position. So if they have to reduce, that's fine. But obviously, when they're in a financial position to increase it again, they should. But it's a really good alternative to the banks. But I caveat that by saying you need to check in as to whether you're paying back a loan at a higher rate of interest, or indeed, are you not funded sufficiently for your pension? So this is what I was saying about ensuring that you have the appropriate balance in relation to your income and your expenditures.
Okay, great, thanks. The next one is now a good time to top up a pension?
In general, yes, because markets have fallen since the start of the year, but that's not really the main reason. The main reason why someone should look to invest in their pension scheme is because it offers a very generous rate of tax relief. If you're a high rate taxpayer, that's at 40%, and that the fund grows tax free. So, funds can fall further. And the key thing is that all of the information, all the news that's out there, as negative as it is, has been priced into the market. So it's not really about whether now is a good time to invest in a pension or any financial asset. Yes, it will get more value than it would have done 2 months ago, but funds have done very well, and we've had a short-term pullback. But the key thing is that it's about trying to make your money work, and a pension vehicle is a very attractive one from that purpose.
So considering stock market volatility threatening investments and inflation threatening cash deposits, what is the best low risk option for placing money over a 3-year period?
3 years is quite a short period to invest for. Typically, we say 5 years is the ideal time scale. Notwithstanding, again, it depends on the amount involved. The unfortunate thing is that by leaving money in the banks, whilst it is arguably risk-free, you are in some cases going to suffer from negative interest rates, which some of the banks are charging now on personal deposits, but also that inflation, even at its low levels, is going to affect the value, as I showed earlier. So it's about this blended approach. It's maybe looking at putting some of your money into assets that can work, but do carry a certain degree of risk, and the insurance companies, and there are some very good options out there, offer different choices for different people. So someone who is a bit more conservative will have certain choices to those that maybe have a longer time scale that can take a bit more risk.
There's another question. What is considered a reasonable pension pot at retirement age, i.e. 300k, 500k, 1 million, 1 million plus? Assume sole worker in the house, wife not working, and no kids to support.
That's a really good question, and it's one that comes up quite frequently. So one of the services that we provide people, and it's something that I would suggest that everyone on this call or anyone listening back to this should ask themselves is, do they know as of now roughly what's in their pension scheme and roughly what is it going to be worth when they want to draw it down? So many people who are, say, part of company pensions, they get projections from their pension provider at age 65, but they may want to draw that benefit down at 60. They have no desire to work beyond that. And what we say to them is, well, let us do a specific projection for you and roadmap that out. And it's really important to do this, that you have a sense of what it's likely to achieve. And then what you do is you check in once a year, and the plan has to be adaptable. It'll vary depending on whether you make an AVC payment, for example, or what the performance of the fund has been. But in answer to the question, typically my rule of thumb is that 500,000 euros is a decent pension to aim for. In that specific question that was asked, because that person is the sole, I suppose, pension investor, they may want to look for a high amount. The best pension you can ever achieve in Ireland is currently 2.15 million. It might be reduced in time. Sounds like a ridiculously large amount of money, but again, when you factor in the rate of inflation, which will erode that over a course of years, and the fact that you're looking to try and live off this for the next 30 plus years, it's not quite as lucrative perhaps as it might seem. But the average pension in Ireland, to put it in context, is around 200,000 a year, which is quite low, and that's why we do encourage people to consider putting money into their pensions, particularly at times of volatility like now. Not because it's a good time from an investment perspective, it's just that it's harder to make money in these types of environments. So getting the 40% tax relief is one way of guaranteeing a return on your investment.
What is your view on interest rates, and will ECB be forced to act given the current inflation?
Interest rates are very low historically, and they have been for a long time. And as well as that, the irony of what's happening in the Ukraine, as terrible as it is, it looks like it's going to pause what was going to be the rise in interest rates, which ironically has caused the volatility earlier in the year to take place. So my personal view is interest rates will probably remain lower than they would have done for the remainder of this year. They are going to increase. The long-term or medium-term view on interest rates, I think, is still, historically quite low. And the effect of that is going to be that it will cause, I suppose, stock markets to probably go more into line with normal times. We've seen an exceptional run of investment stock market performance, which, isn't a bad thing, or it's not a good thing necessarily, but it just means that, the likely rise in interest rates, which is going to happen, I believe, will be relatively moderate for the foreseeable future.
There is another question that's come in. It's, how is the Prisma 5 Zurich currently performing? I looked 5 weeks ago and it was making about 13%. However, I am sure it has fallen back. Will this recover?
So the Zurich Prisma 5 fund is a fund in that risk category 5. Again, like that, it's been in operation since 2014. It's been one of our favored funds for longer term investors, particularly in pensions and for child savings over the longer period. The returns of 13%, I think, are an annualized return over the last 5 years. So to put it in context, it's a phenomenal return. Year to date, the fund is down about 7.9%. We're not overly concerned insofar as I said, whilst it may sound awful that a fund has fallen by that amount in the first 2.5 months of the year, the key thing to note is that, again, we always tell people it's about investing over the longer period. And it's a fund that we really like in that it gives Zurich the ability to manage what they see being the best investments in that risk category. So the short answer is yes, I do believe it will cover. and I still feel fundamentally it's one of the best funds in Ireland.
Another question here, what it says, you said pension to last up to 30 to 35 years. Surely retiring at 66, pension should last for 20 to 25 years.
Yes, but not everyone retires at 66. Many of our clients are looking to try and achieve what we call financial independence at age 60, and some people before that. So that's why I was using maybe a broader scale. The other thing to remember is that your pension doesn't need to end on your demise. I know it's a very morbid thing to say, but typically the way that pensions operate now is that if you have a pension fund, using an example earlier of 500,000, and you draw your 25% tax-free cash, you have your 375 and you draw an income from that. If God forbid you pass away, let's say at 70, 80, 85 years of age, and there's still 50 to 100,000 left in your fund, that goes to your next of kin. If your spouse, or if you've been married, predeceased, or your partner, it goes to your children, and if there's no kids, it goes into your estate. So it's still a financial asset, and hence why it can be over a longer period for someone else if it's not for you.
Okay, and just one more. What industry do you recommend investing in right now?
Again, we're getting back to the speculative part, and whilst we give our views to our clients, and we talk about the likes of these ESG funds, the more environmentally friendly, which we were talking about last year, not just because of what's happening. Really, my best piece of advice to you to finish off with, and I'm conscious of time, is that the most important thing is you give the investment managers who are qualified and expert in this the ability to do what they're paid for. And hence why I'm not really keen for people to try and get too specific, certainly not in this moment. I have over 25 years experience. I worked in investment banks for many years. And even at this stage, I wouldn't be trying to pick an industry that will do well. Anyone who bought oil 2 days ago is sitting on a loss currently of about 20%. If you bought gas, you've lost about a third. They will be hugely volatile. I'm not really into trying to pick markets personally.
Okay. I think that's it with the questions. So do you want to wrap it up there, Nick?
Yes, just to say thank you all for the questions that you've asked. We will endeavour to get back to any ones that weren't maybe picked up. And if anyone would like to kind of maybe, reach out to us, as I say, particularly in relation to just doing that kind of snapshot check, it's really easy. And we'd like to think that we can add value to you without any obligation. I know that there's some existing clients who are listening to this call, and if they would like to have a review with us, we're always available, myself, David, and the other members of the team. And just to say thank you very much again, guys. And again, look, hopefully this situation in Ukraine does resolve itself sooner rather than later. But the key thing really is just not to make too many emotive decisions. Any decisions that you made last year, the year before, and indeed any that were made by Alpha Wealth or indeed another broker, I think it's trying to stay. The biggest thing is not to do anything. And sometimes that's the hardest thing to do, but sometimes it's the best thing. So again, get proper advice, guys. Don't pay for the advice. Some advisors are trying to charge for advice, and I don't know if that's always the best thing, certainly in times like this. So do feel free to reach out to us. And as I say, we're happy to do that review for you. Thank you very much again. I really appreciate your time.